Welcome back to Krown's Crypto Cave, and welcome to this next entry within this options tutorial series. Today, we'll actually be going over one of the strategies, one of the 33 strategies in the Master Your Options program, and that is the call spread, a very basic strategy. It's one of the strategies that we go over pretty much near the beginning of the program, but it is very important to understand because it essentially forms the basis of a lot of the other more advanced strategies that we get into later. Of course, this video that I'm about to present is to be taken into context of a 52 video long series, which makes up that Master Your Options program. So please don't let this overwhelm you. Obviously, we're going to go through some much more advanced applications of the call spread, very different applications of the call spread, even though this is still, again, in the earlier segment of this. But the basis of it is quite simple. A call spread, buying one call, selling one call, different strikes. That's all it is. So of course, I also do want to talk about the Master Your Options program. The link's in the description of this video, but I also want to down talk it as well because with all my programs, this one especially, this one perhaps even more so than the other ones, are meant to be taken by someone who is looking to do this in a more professional setting, typically as a living, which I understand is not going to be most people. So if you are not gung-ho, if you are not a diehard, this program's not for you, and that's completely fine. I don't mean to down talk anyone, of course not. I just want to make sure that the person who gets into this program is a good fit, because also you will be getting yourself into the hidden Discord community, which is going to be a lot of like-minded people essentially going after that same sort of lifestyle. Maybe not all professional traders, but very, 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 very serious for the most part. So again, understand that. Of course, I will be having a sale pretty damn soon. Actually, I'm assuming after this video comes out. So check that out. And again, the links in the description of this video. I hope this series has found you well. This will be the end of the series, and take care. Welcome to this next trading strategies module within this options mastery program. Today, we will be focusing on the call spread. Now, before we begin, just like the put spread, this is a very integral part to my own personal strategy. So we're going to lay down the foundational groundwork here. However, understand that in the future, at the end of this program, we're going to be going into much more sophisticated workings of the call spread. And essentially, it's one of those things where we can always, we always want to keep it in the back of my mind, as it has so much so much variability and so much viability within just trading in general to manage positions, turn losses into gains, essentially manage risk. All sorts of different venues of trading do a lot of the time come back to the call spread. So again, with that said, let's get into the overview over here, what we will be discussing throughout this module. Again, you'll notice there's no Krown stake at the end of this one. Again, that's because I'm going to go over at the end of this, at the end of the program essentially, and talk about the more advanced strategies on how to use this. Okay. Without further ado, let's get into the introduction. Call option spreads are similar to calendar spreads in every facet except for the expiration date of the two options. These spreads that we're talking about here, the call spreads, are executed on the same expiration, meaning the positions will expire at the same time. And in fact, just about any strategy we do is going to be executed on the same expiration unless otherwise specified. And how would you specify it? Well, the word calendar will be in there somewhere. Other than that, the same logic applies with buying one strike and sell the other. Dependent upon the current market outlook, it will be up to the trader to decide whether it's best to be a buyer or seller of the closer strike price and vice versa for the further out strike price. So again, we're gonna go through actual examples on what this is going to look like when you actually use it. And let's get into it right now. The bull call spread. So the bull call spread, we're going to be longing one at the money call. It can also be in the money as well. We're going to show the difference of that just like we do with the put spread. And then we're going to short the out of the money call. So this strategy is best used if the trader is bullish on that expiration. And here's the thing. It's not just if the trader is bullish, it's if the trader is really looking for a nice move to the upside, perhaps even a breakout move. We're buying the premium of the at the money call will be the meat of the trade. That's going to be what's producing the profit, as it will have a higher premium. So we're going to have to really, get the price action in our favor over here. But we're using that out of the money short call to lessen the cost of buying the premium. So it'll theoretically cost us less. By the same token, in general, it is better to be buying the call closer to being in the money and selling the call further out of the money if you're bullish on the market. Again, keywords, if you're bullish on the market, not just looking for a range to the upside, but an actual move to the upside, perhaps perhaps breaking a nice resistance. Selling the far out of the premium, in this case, reduces the cost of the long position if price were to fall against the trader, but also causes the point of profitability to be to the upside to be higher than if the trader were to just buy a naked call. So that is the drawback of this. And I know that I'm in some ways it might sound like I'm repeating myself here, but these are very important nuances to understand because again, we're going to build upon this in the future. So I want you to be thinking now, even though this is relatively early in the program, I want you to be thinking now, what can we do to shift the odds around? And I'll probably slip up just like I did with the put spread and tell a little bit more than I really plan on in this module here. Okay, so let's get on over to the calculator. Current price of the underlying is let's go check in on Bitcoin over here is 63.87. So I'm just going to keep this 63.85 over here. And again, we're going to be longing the. First, we're going to try it with doing the in the money call, and then we're going to short the out of the money call. Then we're going to show what happens if we long the at the money call. But as you can see right here, with the current inputs, this is going to be an extremely profitable strategy. But of course, we need to actually go into the charts over here and see what ByBit is quoting them at. Again, if you've been following along, my short calls that I began this program with actually just expired. You just saw them expire right there. They are now out of the money. They expire out of the money. They are worthless, and I get paid whatever. I don't know. I sold them for like 130 bucks 10 or 20 times. So again, just showing how that kind of goes on over time. I did not record these videos in chronological order, so this will be a little bit out of place, but but understand as it goes through, hey, that's what it looks like literally 1 minute before expiration, 1 second before expiration. Okay, so let's go to the next weeks now. This is expiring in 7 days, and let's see what is our cost going to be for the call. Looks like we can do it for about, let's call it 110 in the middle right here. Okay, we can sorry, we're doing the 62, we're going to do the in the money first. So let's do the 6250. It's going to be 225, 240. So let's just call it 230. I know it's not exactly in the middle, but close enough. So 230 right here. And how much can we short the 6750 strike for is the question. Not too much premium on these guys with just 1 week to go, about 35 bucks in the middle there. So what is our profit and loss graph going to look like? Well, it actually looks like this. Similar to a long call, but without the unlimited profit potential. The profit is capped. The loss is also capped. Now, you'll see over here on the risk reward, not bad, actually. If you put this position on right here, literally right here, you know, not even using any sort of technical analysis tools in your favor, risk reward is over 1.5. You're going to be, your maximum profit is $305, and this is just for one contract on both sides. And your maximum loss is $195. Now, what if we did this? You know, I mean, obviously, if we do it 10 times, it's going to be 10 times more. But what if we did this 50 times more? Because at some point in time, this will be an option. No pun intended. But your maximum profit is going to be $15,250 for just 50 options over here. Okay, back on to this over here. Just keep it simple over here. Okay, so our break even is going to be 6,445. So we do need about a $50 move to the upside, or sorry, I guess that would be $60 move to the upside to be in profit. So again, that is kind of the risk here. We do need a decent move to the upside, especially speaking on relative terms on Bitcoin's price action right now. Again, if you've been following along in this program, which I started months and months ago in August, early August of 2018. It is now late October of 2018, almost November. And you can see over here that price has been relatively stable recently. Okay. So now I said that we try this with an at the money as well, just like we did with the put spreads. And so let's see what would happen if we longed the 6,500 call strike. Remember, if we're doing 6,250 before we go, our break even is going to be 6,445. Okay. So if we did 6,500 strike, and how much can we sell these babies for? We could do, let's just call it 105. Or sorry, buy them for 105. Okay, so here you can see our break even is actually significantly higher, 6,570. So what's really best to be doing when you are thinking or considering doing a call spread or a put spread? Well, understand if you buy the at the monies, you're gonna have to generate a much bigger move in your direction, in the direction, in order to generate a profit. Now, the positive thing is that you will generate more profit in general. 180 bucks is your maximum profit, and you risk less. You're only risking $70, but again, you need to move. This would be a relatively big move for a Bitcoin currently speaking, to about 6,570. So again, do keep that in mind. Now, I'm going to play around again. I can't help myself, but just think what happens. What happens if we short 5 of these out of the money calls? They're pretty out of the money, right? Now I break even. Now we do have a break even to the upside. It's $6,830 though. Maximum profit is $320, and we make money all the way down as well. Okay, just pointing your your thoughts in that direction. We'll go back to the normal one. Again, I'm getting way ahead of myself. We want to just get the foundational groundwork laid out right here. So this is the bull call spread. So pretty simple, pretty straightforward. Let's go on to the bear call spread. Okay, the bear call spread is going to be quite literally the opposite. We're going to be shorting one at the money call and longing one out of the money call on the same expiration. Best use if you're obviously bearish, as the name implies. Selling the premium of the at the money call will be the meat of the trade, as it will have a higher premium. So the trader then uses the out of the money long call to manage risk for a move against to the upside. By the same token, in general, it is better to be selling the call closer to being in the money and buying the call further out of the money if the trader is bearish on the market. Again, I know I'm speaking in circles here, but there are nuances within this statement. How far in the money do you want to do the short call? You could do the at the money strike, you could do the in the money strike. You could even technically do an out of the money, 2 out of the money strikes, but just further out. This is my point. So again, I understand that this might sound redundant, but with options, there are an endless amount of options, to use a bad turn of phrase. But again, do start thinking in that vein of thought. Okay, so buying the far out premium in this case reduces the risk of the short position if price were to rally against a trader. So we're using the long premium to reduce the risk. And remember, it's going to cost less inherently the further out that you go, because always far out, further out options are going to have a lower premium associated with them. But also reduces the profits as the trader has put a sunk cost essentially into buying the premium of that option, which may expire worthless if out of the money. Yep. So we're gonna be basically, when we short the at the money call, the long out of the money call is basically going to cost us. So we're giving up a little bit of profits in return for some better risk management, instead of just having unlimited risk. Okay, so let's get into it over here. We need the bear call spread. Where's my bear call spread? There we go, number 29. Alrighty. And let me just make sure I'm recording. Okay, great. I've gone through a lot of these modules where I realize I'm about 20 minutes in and I'm not recording. So I apologize. Apologize about that. Okay, so again, we're going to be shorting the at the money call strike first, and then we're going to long the out of the money call strike. So we can use the same values that we did here. It's the same idea, same current price of the underlying. And where is our break even point? Well, our break even point is at 6,570 right here. As price action goes above that, we start to lose and lose and lose until we get to maximum loss all the way over here. Now you'll notice our maximum loss is much higher than the opposite strategy. That's because we're selling this very meaty in the money call. So as that goes against us, it will hurt. And the 6750 strike is not going to help until you really start getting around, until you really start getting around 6750. So again, as you can see, that's where things flatline. So again, as you can see, I'm I'm going to give you an insight into what we're going to be doing later. What's the best way to manage risk if this were to go against you to the upside? Well, what you can always do is you can buy back the at the money call strike, or that's going to be the best for your margin, or what's going to be best for your profit and loss is to actually just buy the spot underline. Okay. Anyways, before I get too ahead of myself. All right, let's show what happens if we short a deep in the money call, the 6250 strike, as this will have a lot of premium on it. So I'm gonna guess, take a guess right now. It's probably gonna have more premium and a tighter range associated with it. But let's see how that reacts. Okay, so we can short this guy for let's call it 230. Again, I know it's not perfectly in the middle, but again, close enough right now. Okay, 6250 strike call. So our maximum profit's going to be more. We have 195 compared to what we had before. And that makes sense intuitively because you're selling a more expensive premium, but the range is tighter. Remember, when we were selling the at the money, the 6500 call strike, our break even was around like 6550 if I recall correctly. Now our break even for selling the deep in the money is 6,445. So it's a much tighter range. Now we're immediately profitable. Remember the price of Bitcoin is currently 63.85. So as long as you stay below this resistance right here, again, knowing just a little bit of technical analysis and getting way far ahead of myself, but as long as you're below this guy right here, you're good. In fact, this is all profit to you over here. So again, you will get to a maximum profit point, at which point you no longer make any more profit, and your maximum loss will theoretically be more as well. Your risk reward is not looking too good, but remember, what if we bought, again, getting ahead of myself, but what if we bought 3 out of the money long calls just to reduce it a little bit more? Well, that's going to change the whole damn picture now, isn't it? What if we bought, that would be a pretty terrible position. Although there are strategies like that. Again, I do feel like it's important, just as an offside topic, I do feel it's important to go over all of the different strategies within the options realm. However, the purpose of this program and the value in this program is going over what actually works and how to make the most out of what actually works. So is this a great strategy right here? I would say no. But it is actually one of those strategies, I believe. One of the creature names. Okay, going back over to this. Okay, vanilla strategy right here. Again, just keep your mind working in those directions. Now, what happens, again, getting ahead of myself, but I just want you to think about this. What happens if the price action goes to the downside and we're deep in the profit, maybe price action goes all the way to 6250, we break some sort of support along this area right here and just it's free fall down. What's the best thing to do? Well, you could sell more of these calls. What happens if we sell 3 of these guys? Look at that. Our break even to the downside is now 6,468. So it hasn't really changed too much, but we are making much more money now. $655. Okay, again, just giving you an insight into what we're going to do later. I think it's a good idea to get your mind turning towards that area, but don't let that sort of thought process overwhelm you right now. We're going to go into it in more detail later. Okay, profit potential calculations now. Profit potential when buying the in the money call for essentially the bull call spread. The trade is at maximum profit when the price of the underlying is greater than or equal to the strike price of the short call. So again, the strike price of the short call in that scenario was 67.50. So as long as the price of the underlying is greater if the price of the underlying is greater to or equal, then let's actually just go show it. It's best to see it visually. Okay, bull call spread 27, just making sure. Okay, 27 and 29 is what we're operating on. 27 over here. Let's do 1-to-1, and we're gonna do 65. Let's go get our right inputs back in here, and the 65 strike was 105. Okay, there we go. Okay, so. Remember, if the price of the underlying is greater than or equal to the strike price of the short call, so that's 67.50, we should technically be at maximum profit. Is that true? Yes, it is. 67.50 is right around here if you can just eyeball it out, and at that point you are at maximum profit. Beautiful. Maximum profit is going to be equal to the strike price of the short call, 67.50, minus the strike price of the long call, 6,500, minus net premium paid. Now, net premium in this example, we bought the call for 105. We sold the call, the out of the money call for 35. So that would be $70 net premium paid is what we paid to put on the position. And maximum profit is going to be equal to 180 if we do the calculation over here. Okay, let's go over to the bear call spread, and I'm going to go to 29 just so we can get it queued up and ready. Okay. The maximum profit is equal to the net premium received. What's the net premium? Well, again, we sold the call for 105. We bought the out of the money call for 35. So our maximum profit, $70, as we discussed before. The trader will, whoops, getting ahead of myself. The trader will be at maximum profit when the price of the underlying is less than or equal to the strike price of the short call. Less than or equal to the strike price of the short call. Our short call is 65. As you can see, if you just eyeball it in here, that'd be right around here, and you're at maximum profit as long as you're below there. Okay, risk potential. Again, we're going to go back over here. Start with the bull. Okay. Maximum loss is equal to net premium paid. Yes, we know that. It should be evident in the calculation over here. Yes, maximum loss. We've done net premium, $70. The price of the underlying is less than or equal to, sorry, the trader is at maximum loss when the price of the underlying is less than or equal to the strike price of the long call. The strike price of the long call was 6,500. Let's go see if that was true. 6,500 right here, kind of eyeballing it out. And yes, as soon as you get there, you're at maximum loss and it is constant. Okay, let's get the next one queued up as well. Okay, 29. Okay, great. Alrighty. For the bear call spread, maximum loss happens when the price of the underlying is greater than or equal to the strike price of the long call. So the strike price of the long call was 67.50. So around here, you can eyeball it out around 67.50 right here. You are at maximum loss and it is constant. Maximum loss is going to be equal to the strike price of the long call, 67.50, minus the strike price of the short call, 6,500, so 250, minus net premium received, $70. So 250 minus 70 is 170, I believe, if I'm doing my calculation correct, 180. 180 right here. We can just trust in the calculator. Okay, break-even analysis. So let's start with the bull call spread. Going back on over here. Okay, the break-even point is going to be equal to the strike price of the long call, 6,500 plus net premium paid, $70. So 65 plus 70 is going to be 6,570 right here. And that's exactly where you're breaking even. Beautiful. Okay, let's go confirm the bear call spread. When selling the in the money call, there is one break-even point, and it is equal to the strike price of the short call, so 6,500 plus net premium received, $70. So it'd be the same price, $6,570. They both have the same break-even point in the vanilla strategy. You're just positioned for different moves. Okay, so that's going to do it for the call spread. Again, an integral part to our overall strategy. We're going to go into it and expand on it much more throughout this program. Be on the lookout for, hey, if you want to, the best way to manage this would just be to do the spread, spread it out here, spread it out there. Maybe sometimes a calendar spread, which of course we'll go through in the following modules. But again, I just want to get your attention positioned towards that sort of thought process as, again, a very integral part and extremely versatile. I hope this one finds you well, and I will see you in the next one. Take care.